It's something I warn about in this "don't fuck this up" thesis, which is don't take leverage. Don't try and trade around or FOMO into stuff. Just be careful what you do and stick to the basics, stick to the bigger tokens. If you're gonna degen into stuff, do it in the smaller stuff, because that stuff's much more volatile. Your probability of getting it wrong is very high, although you can get 100x in the space as well. I understand that's attractive to many people, but I'm trying to keep everybody on the straight and narrow. And when you see these drawdowns, it always feels terrible. And I've been doing this since 2013, and they always never feel great. But the reality is, it's normal. So the forward-looking basis, liquidity is going to come back. Is it going to be this month or next month? I don't bloody know. It doesn't really matter, because we're not in it for the short-term trade. What we know is it has to come back because of the everything code and the financing of it. Start thinking this thing through, start preparing for where this is. The next phase usually happens around this halving period. The next phase is when the banana zone happens. That's when everything starts accelerating. So often we have a slower drag up and then we start going. That's what I think happens. That's the altcoin season. That's when things start to get really bananas.
Raoul Pal begins by addressing the core nature of cryptocurrency markets, their volatility. He emphasizes that crypto is inherently a 70% volatility asset class, characterized by deep drawdowns and significant upside potential. This extreme volatility is not a bug, but a feature of what Pal describes as the best performing asset class in recorded history. However, with this potential for massive gains comes the risk of equally dramatic losses, which is why Pal advises caution. His "don't f***ck this up" thesis revolves around the idea of managing this volatility wisely. He warns against leveraging positions or succumbing to FOMO, fear of missing out, which can lead to catastrophic losses. Instead, he advises sticking to the basics, investing in larger, more established tokens, and, if one is inclined towards higher risk, high reward opportunities, to do so with smaller, more speculative assets. The key, according to Pal, is to remain grounded and avoid the temptation to chase every market move. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
As I've always said, crypto markets are volatile by nature. It's a 70% volatility asset class. It has deep drawdowns and it has tremendous upside. In fact, it's the best performing asset class in all recorded history. But with that best performance comes volatility. It's something I warn about in this "don't fuck this up" thesis, which is don't take leverage. Don't try and trade around or FOMO into stuff. Just be careful what you do and stick to the basics, stick to the bigger tokens. If you're gonna degen into stuff, do it in the smaller stuff, because that stuff's much more volatile. Your probability of getting it wrong is very high, although you can get 100x in the space as well. I understand that's attractive to many people, but I'm trying to keep everybody on the straight and narrow. And when you see these drawdowns, it always feels terrible. And I've been doing this since 2013, and they always never feel great. But the reality is, it's normal. So it's normal in the fact that in the last 12 months, you've probably forgotten this, but this is our 5th or 6th 20% pullback in Bitcoin. So you've dealt with this many times before. You just kind of forget it, which is weird. And I think Coinbase put out a super interesting tweet, which was, there have been 5 Bitcoin bull markets. In an average bull market, you'll have to survive the following to ride it to the top: 6 5 to 10% drawdowns, 3 10 to 20% drawdowns, 2 20 to 30%, 1 30 to 40, 1 40 to 70, and that's all during a bull market. So it takes a certain kind of gumption. It takes an ability to turn off Twitter, to turn off your screens and say, has my thesis changed? Is the adoption of this technology stopping? Is there any other reason that it's going to slow down? Where are we in the business cycle? I spend enormous amounts of time trying to educate you guys that this is a macro asset and it's driven by the business cycle. Just happens to be forward-looking, like technology stocks, and it's driven by the liquidity cycle. So has something changed in the business cycle that would tell us that we're going to have a failed crypto cycle? Well, in all probability, that's a no. So therefore, it's corrective price action. And if you happen to have extra money on the sidelines, use these corrections to add. That's what I did. I was lucky enough to have a bit of cash, and I added to my Solana position. Great. And I found that compounds really well over time. It's a key way to make better returns out of this space is use the drawdowns to your advantage. Even the big cyclical ones. I didn't sell out of anything last time. I had no intention of it. It wasn't that I missed the top or anything else. I knew that to get back in is really hard. If you take X sum out, you never put X sum back in again. You go smaller because you don't want to risk it all. Your whole psychology is screwed up. So what I prefer to do is say, well, this is a longer term trade. When we get the big drawdowns, I just want to add. And then you compound and you're back to all-time highs well before the market is. And that is really, really a superpower. So what's going on now? Why is crypto so shaky? It's the same reason tech's been shaky. It's liquidity stupid. Remember, I've told everything about this everything code cycle. Liquidity is the big driver of all asset classes, and particularly crypto. It's the most receptive to liquidity injections or withdrawals. So I correctly managed to time the bottom in 2022 based around the liquidity cycle. And the forward-looking elements of the liquidity cycle continue well into 2025. So I don't have anything to concern over. So therefore, we're looking at the wiggles in liquidity. The liquidity air pocket was happening. If you think about the US liquidity, it's driven by the Fed's balance sheet, which they've been doing QT, so they've been tightening it, making liquidity less available. But that's been offset by the treasury, by the draining of the reverse repo. The reverse repo is an offset to what the QT was doing. And in the meantime, the other part of the equation is the Treasury General Account, which is the checkbook of the US government that Janet Yellen controls. And she's been building that. But these have meant the liquidity based back in 2022, and it's been going vaguely higher. The everything code cycle taught you that there is no way of financing the debts. It's now become a word people use, fiscal dominance. This is the everything code cycle I started talking 2 years about. The everything code cycle says, well, if GDP growth is too slow, then the amount of debt in the system is too high. So you need either interest rates to come down or you need growth to go up. Now, growth is driven by demographics over time. There's not much we can do about that. You get cyclical growth, but you don't get the overall trend rate growth, which has been slowing. So the available GDP has to pay the interest on the debt between the government sector, that's 100% of GDP in debt, and the private sector is 120% in debt. So we've got not enough GDP to cover the interest payments. This gets really exacerbated when interest payments are high. Trend rate of GDP growth is about 1.75%, call it 2%. So there's not enough GDP, which is why the bond market's been freaking out. Over time, yields have risen, even though the Fed have been talking about cutting rates. And this is the issue of not having enough GDP growth. This is the everything code cycle. So what it leads to is what's known as more cowbell, which is stimulus. Stimulus can come in a number of ways. So the most obvious way is reducing interest rates themselves. That has been a typical path. The other way is the backdoor mechanism of injecting liquidity into the system. Quantitative easing is the best known one. The other one is draining the reverse repo and also draining the Treasury General Account. So those tend to be those, and then there's some more coming, and I'll come into that in a sec. So where are we today? Why did we have the air pocket? Well, QT was going on, so they're selling bonds. The Treasury had started building up cash reserves because tax payments have come into the system. They come out of money market funds and go into Janet Yellen's checking account. And that's taken liquidity out of the system because she hasn't spent it yet, so it's just sitting there. She's been trying to help the market by issuing short-dated bonds. That's drained the reverse repo.
Pal's concept of the everything code cycle is a framework he uses to understand the interplay between debt, growth, and liquidity. He argues that the current economic environment is characterized by fiscal dominance, where the need to service government debt drives policy decisions. With GDP growth too slow to keep pace with rising debt levels, Pal believes that central banks will be forced to inject more liquidity into the system, either through lower interest rates, quantitative easing, or other measures. Pal argues is not unique to the United States, but is a global phenomenon. He points to Europe and the UK, where similar dynamics are at play. The European Central Bank ECB and the Bank of England are both likely to engage in liquidity-boosting measures to manage their own fiscal challenges. This global injection of liquidity, Pal believes, will ultimately support the next phase of the crypto market's growth.
So there's liquidity coming in the system at a structural level, i.e. they're creating another larger buyer of bonds. We will see more of those kinds of things over time, and we're going to get much more liquidity. But this is just the Fed. Over in Europe, well, the ECB want to start cutting rates soon. That's going to start injecting liquidity into the market. They're also still planning their big green energy initiative to lower the cost of electricity in Europe, which is actually good for productivity. I know people think it's a waste of money throwing money around at green energy activities, but it's not, because over time you'll force down the cost of electricity, and that increases productivity and that helps GDP grow. But in the meantime, they will end up financing more of this with issuing green bonds or whatever it is. There's going to be a way that they will inject liquidity via this as well, because they don't want to use the balance sheet if they can avoid it, because everyone knows what the balance sheet is, the printing of money. Okay, so Europe's probably in the equation. The UK is similar. They blew up their gilts market last year. They will do some injection of liquidity for sure, whether it's via rates or whether they can find a backdoor excuse to do something else. Obviously, Basel IV for all of these helps. So the forward-looking basis, liquidity is going to come back. Is it going to be this month or next month? I don't bloody know. It doesn't really matter, because we're not in it for the short-term trade. What we know is it has to come back because of the everything code and the financing of it. Start thinking this thing through, start preparing for where this is. The next phase usually happens around this halving period. The next phase is when the banana zone happens. That's when everything starts accelerating. So often we have a slower drag up and then we start going. That's what I think happens. That's the altcoin season. That's when things start to get really bananas. I'm looking forward to that. I'll keep you posted as that starts playing out. But right now, we should be looking for low in markets as liquidity is signaled to improve, and liquidity will start to improve. And then as we go from that, we can look at, okay, how long does this cycle last for? But the back end of this year, it's all going to be about bribing election, making sure you can pay the deficits. And that's pretty much everywhere. Everyone's got to pay the same bills, which is their cost of their government debt. And there's only one way round, and that's more cowbell. Anyway, nothing to worry about. Pretty ordinary markets. It's just something you have to get used to in crypto.
Pal is optimistic about the future of crypto markets, particularly as we approach the next Bitcoin halving event. He describes this period as the banana zone, where the market begins to accelerate rapidly, driven by increasing liquidity and the cyclical nature of the crypto market. Pal advises investors to be prepared for this next phase by staying informed and ready to act when the time comes. He expects the latter part of the year to be characterized by increased liquidity injections, particularly as governments seek to manage election-related spending and fiscal pressures. This environment, Pal argues, will be highly favorable for crypto, setting the stage for significant gains. Please like and subscribe my channel.